Welcome back to the Retire in BC podcast. I'm Arnold, and today we're talking about something that doesn't always get framed as part of financial planning, charitable giving. For a lot of people, giving is something that they do casually or reactively. They make a donation at the end of the year, get a receipt, and move on. But when it's done intentionally as part of a broader financial estate plan, it can be a lot more tax efficient, more flexible, and more importantly, more meaningful. Today, we're going to walk through how charitable giving fits into financial planning, from donation receipts and tax considerations to estate planning strategies, to tools like donor advised funds. We'll also share a couple of real client examples that show how planning can turn generosity into legacy and how they can create way more savings than might otherwise be done. So whether giving is something you already do or something you've been meaning to think about, this episode will give you a clearer framework for how it all fits together.
Yeah, and I think it's important sort of to realize that giving, it's not separate from your financial planning. It all ties in together. It affects your cash flow, it affects your tax strategy, how you design your estate. Your personal values feed into that the same as they feed into your regular personal finances. And I think oftentimes you kind of hear some sentiment of, okay, I'll worry about that later. And I think to some degree that makes sense. I'm a big believer myself in putting your own oxygen mask on first. But I think if you're someone who is giving along the way and you're doing it right now, it's worthwhile just giving some of that thought about it, or even if you're just thinking about doing it later, just planning how you're going to structure that out. Planning a bit earlier gives you a lot more flexibility and therefore also, potentially a lot more impact to what you're doing. So why don't we just start with, I guess, the first most basic way to give, and arguably the least efficient way to give, which would just be donating cash, giving money up front. When you do that, you can collect a tax credit. The federal government gives you back some of your money on your taxes for being a charitable person. And so you just collect some money back. The actual worst way to do it is to donate cash and to not get that credit at all, right? Which is one thing we'll talk about in a bit. But generally speaking, if you make a qualified donation, you will get a tax credit on your return if you claim it, right? And so the way that works is on the first $200 that you give in a year, there's a federal one and a provincial one. I mean, we're in BC, so we're mostly just going to lump them together. But in total, on the first $200, you get about 20%. If it's above that, if you give more than that in a year, it ends up being significantly higher. There are kind of three bands there, but for the most part, most people get the 46% back. If you're a way high income earner, well, then you get the full, it works out to the top marginal tax bracket in BC, which is $53.50. So if you're a high income earner, if you donate above that $200 threshold, like let's say you donate another $1,000, you get $535 back on your taxes, right? Which is not a bad spot to be in for doing something you might have done anyway.
It is really confusing, and just to give some history to it, it used to be, it was still kind of confusing, but it was a little bit more clear what happened because it was binary. What happened was many years ago, the government switched from charitable donations being a deduction like your RRSP. If you gave $1,000, you actually got to deduct it off your income. They switched it from that to a credit system. And when people first looked at that, they thought this is terrible because it looked like they weren't getting as much back. But in reality, they were actually getting more back because when they first came out with it, you would get on the first $200 the lowest tax credit, but on everything above that, the highest tax credit. And then just a few years ago, the government messed around with that and basically created some upper bounds. And so now, as Ben said, there's sort of three tiers. There's most, on the first little bit that you donate, you get that lowest tax credit, which is still pretty decent. But then on everything above that, most people get a very good tax break. And so usually it's close to 50%, 46% that you get back. But if you are a really high income earner, then it's actually your marginal tax bracket that you get back. So it is a bit confusing, but suffice it to say, on the amounts over 200 bucks, you get back quite a bit.
Yeah, exactly. And so on that note, like there's with the basic tax deduction from what we've talked about so far, there's not a ton of planning to be done yet. There's a little bit to be done. So if there's me and a spouse and we were both planning to give $200 in the year, well, why don't we have one spouse give zero and the other give 400, and then that spouse gets collectively the household collects more back in that tax credit. So that's one minor way to do it. Generally speaking, it doesn't matter a ton whether that goes to the higher income earner or the lower income
Right.
earner. Uh, within two kind of categories. Number one, you can't deduct your tax below zero. So in the same way that everyone gets the personal tax credit, basic personal exemption, up to let's say 15,000 of income in the year. Well, if you only earn 5 grand in the year, you don't earn extra money from your negative tax bill. You just deduct your tax bill to zero, right? So in the same way here, you have to actually be paying tax to collect that tax credit. And the other component is if someone is a really, really high income earner, like above that 260 grand per year, 300 grand per year range, then they actually get that higher tier, and maybe the
Right.
donations should be in their name. Supposing they don't have other deductions, other credits to offset some of that.
Well, and the other small tax planning tool that you can do if you're donating a small amount, like if it's $200 or under, uh, if instead of donating it instead of claiming it in the year that you do it, if you collect them up and wait, let's say 5 years, because you can't you have to make the claim within 5 years. But if you delay and then lump them all together and claim them in 1 year, then on the first 200 you'll get that smaller amount, but on everything else you'll get the higher amount. So a little bit of planning there that you can do with that.
Yeah, and I mean, long story short here, the takeaway is just that when you donate, you get some cash back.
Yeah.
We beyond that, probably not too worrisome at this stage about worrying about those things. But just a quick example too of one thing our family does. So we give money every year at Christmas, as Arnold well knows, because we celebrate Christmas together every year. But just at that point, typically the family each donates some money into a bucket, and then one person makes the donation and therefore also claims the credit. So if I just said, hey guys, I'll collect this year, everyone give me $100. If I then donate that and I get all of the tax credit above and beyond sort of what my little contribution was, I'd be making money. And so just one thing we do, something to be conscious of, is whoever makes the deduction, we just gross it up to account for the fact that that person will then be getting lower taxes on their return.
Right. Yeah. Yeah. Basically, if you're pooling money and one person is making the donation, don't let them win.
Yeah,
Yeah. Yeah.
exactly,
Yeah. Just
exactly.
make sure they do that. And if anybody's trying to replicate that, just we actually did that quite a few years ago, partly because we felt like people don't need gifts. I mean, it's nice to give them, but rather than donating or rather than giving in the family stuff that they don't need, why not give that to somewhere that's in need? And so basically, all of us just give what we would normally spend on a gift or spend on gifts to each other, and we pool that and look at catalogs and we found it a very enjoyable thing to do at Christmas time, and everybody gets a kick out of it. One thing that I will really stress here. Um, Most of the time, a GoFundMe page, you cannot get a receipt. If that's something you want to support, by all means, support it. But if you are giving to a place that does issue receipts, get a receipt because it's worth it to you. It's worth, that donation receipt is worth real money to you. I was the treasurer of a church, Grace Point Community, for quite some time. It shocked me how many cash donations we got. People who were giving regularly, but just never bothered to collect a receipt. And if you're one of those people that aren't in a taxable situation, I've seen this too. Sometimes seniors are earning so little money they really don't pay any tax or hardly any tax. Um, well, maybe give the money to your kids to donate so that they can get the tax receipt. That's legitimate too. Just there are creative things that you can do. Consider it.
Yeah. One thing I wanted to point out too, so on that tax credit, it's a high limit, but there is a limit to how much you can give. Really, mostly, I think this is more of an anti-money laundering thing than any. But if the government sees that, oh yeah, you earned 50 grand this year, but you're giving 60, they raise an eyebrow and they think, something might be wrong here. So they do cap that credit that you can receive, or the donation amount you can claim as 75% of your net income for the year. So just be wary. It might be totally legit. You've sold some investments, you sold a property, you did something like that. But just you may run into limits on how much of that. If you're making a large donation, may run into limits on how much you can claim. Now, if you've passed away and designated in your will that you want this to happen, then the story changes a bit. You can give 100% of your net income for that year and the preceding year as well. So it is a bit more reasonable if you were to do, and this is for estate planning purposes. It's a bit more easy to get that kind of large donation through and still get the tax receipt that you should be getting.
Actually, I think that's a really good place for me to highlight one thing that maybe I should have highlighted at the very beginning. Actually, two things now that I think of it. The first one being um, sometimes I hear people talk about, oh, the rich can donate and they make money. You never, ever, ever make money donating. If somebody comes to you with a scheme that you will be making money by donating, run the other way because it's a scam or it's something that CRA will come back at because it's not legit. Donating costs you money. You do get a credit for it, so it doesn't cost you as much as the full donation, but a donation, even under the best of circumstances, and we'll show you some really good ones, but even under the best of circumstances, donating money costs you. That was the first thing that occurred to me. I really wanted to just highlight. The second is, and I really should have said this at the very beginning here, I personally believe that it's actually emotionally, psychologically beneficial for us to be donors, to be giving money away. My experience has been people who tend to be generous that way tend to end up doing better with their money. I think largely because there's a high degree of likelihood that they're learning to manage it better. But in my opinion, um, donating money actually helps us, not just the people we're donating the money to.
Yeah, and
Anyhow,
I think
little segue there.
that's well supported by the literature as
Yeah,
well. That it just makes you feel good, makes
yeah,
you a lot of that.
yeah.
Um, Otherwise, too, just wanted to highlight too pretty much everything we talk about in this episode, and you've touched on it already, is that not everywhere issues a receipt. That could be kind of for one of two reasons mainly. One is that they might be a qualified charity, but they just aren't really, well, I guess usually in that case, even then, they can still issue receipts, but they might not really be super well set up for it. They might not be a very large charity. Or number two is just that in order to get a receipt, it has to be a qualified donee. So essentially, there's a list of what the CRA considers an allowable charity for these kinds of donations. Generally speaking, those are registered Canadian charities, with a few other exceptions as well. I think you can give to Canadian municipalities. I think there are certain foreign universities or foreign charities that the government's given to, or things like that. But for the most part, we're talking about registered Canadian charities. That's in order to get a receipt here, as well as most of the other things we talk about too. Donating securities, which we'll talk about in a second, donor advised funds, so on and so forth.
Well, and a charity won't give you a receipt if you're getting a benefit for what's happening, right? Like
Right.
Sharon and I are going to a dinner for the Peace Arts Hospital Foundation in a couple months, and they'll be issuing a donation receipt for part of what we're paying for that, but the part that they deem to be for the event, the benefit that we get, we don't get a receipt for that. So charities do have to be careful about how they do that, but that is a good example.
Yeah, and so the one thing too that I just talked about in terms of donating securities, so we're kind of moving on now from donating cash, which I had said is maybe the least efficient way to give, still a good thing to do, but if you're in a different position financially, there might be some more efficient ways to give. One of those really good ways that we like is to donate securities. And so the gist here is that you've got some shares that might have gone up in value. I think actually, Arnold, you had some
Yeah,
thoughts on
yeah.
this.
Well, and I'll actually provide a couple of examples of where this has worked out really, really well for people. But why don't we walk through an example of how this works? Um, so I've got here a share certificate. This is I don't know if you can read it there, but this is an old brick BC Resources Investment Corporation share certificate. Some of you that are older may remember these. We were all given these back in the 80s. And I'll tell you, I was a smart financial guy even back then in my late teens, early 20s. I was one of the few people I know that actually sold my brick shares because I got 100 or 200 bucks for it and they're worthless now. But I managed to snag a few, so I still have some certificates. But let's pretend for a minute that this is worth $1,000 and that they were given to me by the government. So my cost based on them is zero. It's so the I have $1,000 capital gain on this. If I go and I sell this, I'm going to have to pay tax on $1,000 capital gain. Now, I think we've talked before about how that taxation works. You only get taxed on half of it. So even that's preferential, but still, I'm going to get taxed on that capital gain. Um, so if I want to donate $1,000, and let's pretend for a minute that Ben is the charity there. He's the Ben Machel Charitable Foundation, and let's say I want to donate to that foundation. Well, I could sell this share and get. I've only got a 20 here, but let's pretend it's $1,000. I could sell this share, get the $1,000 and then give it to Ben or to the Benjamin Foundation. If I did that, I'd have to pay tax on the capital gain. Upside down now. I'd have to pay tax on the capital gain, but I would get the charitable receipt, which I could claim on my taxes. But there's something I could do differently. Instead of selling it and gifting the cash, I could take the share certificate and gift it directly to the charity. Here you go, Ben.
Thank you, Arnold. Look at that.
Look at
I've got
that.
the
So
shares.
so then Ben, as the charity, would sell that share certificate and get the $1,000. So either way, the charity gets the $1,000. It's just in the second scenario where I'm gifting it, I don't have to pay tax on that capital gain.
Yeah, well, and so the difference here is that Arnold, as an individual person, if he sells them, he has to pay capital gains tax, he has to pay income tax on those on the sale of it. If I'm a charity, I don't have to pay income tax, right? And
That's
so
right.
I can sell the shares, get the money, and there aren't any tax implications for doing so. And so from Arnold's perspective, you can kind of think about it in two ways. One is by doing this, he saves tax, or two is by doing this, he's able to give more to the charity,
Right.
right?
Yeah. Yeah.
And so in either case, you can kind of wrap your head around it either way to do it that way. But I like to think about it, um, they're kind of one and the same. You're
Yeah.
giving more
Yeah.
by
Yeah.
earning less
Yeah.
tax or whichever you want to do. But essentially, yeah, by doing it this way, it's the tax efficient way to give if you have those appreciated securities. And so I just think on the one hand, like if basically anyone with a non-registered account that does sometimes give, usually they're just giving out of cash out of their bank account. There might be a more efficient way to do it, which would be to gift those shares instead of giving the cash. And
Almost
so
always. Yeah.
almost always. And
Almost always.
yeah,
I
so
mean,
people aren't. Yeah, go ahead.
If it's a small amount, it might not be worth the brain damage, but for the most part, it's worth it.
Yeah, no, exactly. And so that's where too, like, not every charity might be set up to be able to receive these shares. They might not have the brokerage. There are some third party players out there that can administer that and help that kind of thing out. But it's worthwhile thinking about, especially if you give regularly, if you give a lot of money, if you're doing a large transfer. Um, and especially if you have this non-registered account with lots of embedded capital gains. If you've
Right.
got a non-registered account that you just opened that hasn't really appreciated in value or even has declined in value and you want to collect that capital loss, it might not be
That's
appropriate.
right. Yeah.
But
Yeah.
yeah, just something worthwhile to think about.
Yeah. So, uh, two examples, and one of them will highlight what Ben just talked about. Um, Sometimes then you can give more. The other example will actually be an example where the client still wanted to keep the shares, but we gave them away anyhow and just bought more. And again, I'll just touch on how that works. But way back when, we were one of the very, very first people to recognize that, or firms to recognize that with flow-through shares, there was a little bit of a hole in the legislation that would allow an extra benefit flow through shares. You got a bigger tax break, but then you donated the shares and you didn't pay any tax at all. And so we had a thing going for many, many years where people would buy 10 grand worth of flow through shares, get a big tax break, and then planning to donate them a year later. We had one case where somebody was planning to give $50,000 to a charity and they bought into these. They got back $30,000 in tax savings because of the flow through tax savings. A year later, this happened to be just a particularly good one. The $50,000 had grown to 80,000. The person said, "Well, I was planning to give all of this anyhow." So the charity got $80,000. The client received a tax credit on that $80,000 donation and didn't pay tax on any of the gains that they earned from it, and had received 30% tax credit back. So their cost on it was 20 grand. Um, they made money on that transaction. They made money because they took a risk and the investment went up, not just because they donated it, but the donation was a part of it. Today, the rules around those gifting of flow through shares have changed and they're not as beneficial, although they can still be beneficial. But that was one great example of how that worked out. A second, we had a client who had some AppLovin shares as part of a high growth portfolio. Um, they wanted to continue to hold them, but they had made a bunch of money on them and were donating. And I said, hey, you know what? Let's donate those and let's just buy them back. So that's exactly what they did. So what happened was they donated the securities, didn't pay tax on that gain. When they bought them again, their cost on that security went up, right? Because now the cost was that new share price, which was the higher price. So they will never pay tax on that gain. In fact, actually, subsequently, the share price went down a little bit. They sold the shares, and so now they actually have a small capital loss, even though they made a whole bunch of money on the shares. So it just worked out famously. As maybe you can tell, this is my favorite way of donating. It is awesome. It works so incredibly well. And with a bit of planning, it can really help you save quite a bit of money.
Yeah, well, and it's just something that we see all the time that I think most people don't think about,
Right.
is that again, once you've worked on your TFSA and your RSP and you've got this other investment account, or if you have company stock, or if you have this or that, if alongside that you're also giving money, it's worthwhile looking at that.
Yeah. Uh,
So everything we just talked about, that has to do with mostly non-registered accounts, right? When we're talking about capital gains, that's when it's not in a TFSA or RSP. I did actually want to talk briefly about funds in an RSP and maybe some opportunities there. This kind of now relates a little bit more towards the estate planning side of things. Again, so far what we've been talking about is gifting while alive, gifting out of your cash flow, gifting from your investment account, so on and so forth.
Actually,
With,
Ben, can I interrupt real quick?
yes,
One thing I did not mention, and I should have, when you're gifting in kind, like we were just talking about, that applies to stocks and bonds and mutual funds. Yeah, so it's not, you can't gift gold. There are some restrictions on it. Most of the time, it's stocks and mutual funds that we're doing that with. But it is fairly restrictive. Sorry to cut you off there, but it just occurred to me, really, I
yeah,
should
no
have
problem.
highlighted
Yeah.
that.
Yeah, no, that's a good point. But where I was going, yeah, was with the RSPs, in that, like, let's imagine someone's out there, they have a $500,000 RSP. We know that that all eventually has to get taxed. Usually we put it into a RIF, we start withdrawing over it. It's a little bit, if there isn't a surviving spouse, it's a little bit of a complication or a risk from a estate planning perspective that if they, let's say they've named their kids as the beneficiary, well, if they pass away, that $500,000 RSP or RIF, it all has to get taxed. It's all taxed in 1 year. It's a very high tax bracket, so on and so forth. And so it's a big tax burden essentially to the estate and to the next of kin. If they were to name a charity as the beneficiary, so, this presumes that they're a charitable person and they're wanting to give a lot of money to charity as opposed to the kids. But just as an example, if they were to list that charity as the beneficiary, well, again, the charity doesn't pay tax. And so it's a little bit more complicated. The funds don't go straight to the charity. What actually happens is technically it's a taxable withdrawal still to the account or to the estate. But we had said earlier that in the year of death, they can make a donation up to their full net income for the year and claim that deduction. So it is taxable, but then the estate gets an offsetting tax receipt. And since you can donate up to 100% of your income, effectively it's tax-free and you can give the whole amount to the charity rather than paying all of that tax and giving it to the kids. Right. So just something to think about there. Again,
No,
if that,
it's a great point. It goes back to what we were talking about earlier. It costs, but it does save quite a bit in taxes, right? So there is a cost to the estate or to the individual giving it, but the cost is not as great as the gift actually is because there's some tax savings.
yeah, yeah. Well, and so I will just say, like, if you're thinking about some amount of charitable donation and you also have these other accounts, then it's worthwhile just giving some thought to how you're going to align those different things. Does life insurance play a role in it? What does your will say is going to happen? You can start to get a bit more flexible on, okay, well, I want X amount of dollars to go to charity and then the remaining percent of dollars to go to the kids and so on and so forth. You can just shift around things like that. So to our last episode, which was a bit more on estate planning, it is worthwhile just thinking about how these different pieces work together and your overall estate
Yeah,
intentions.
yeah.
So next up, what we had on here was donor advised funds. We love donor advised funds. They're great. In plain English, just what a donor advised fund is. It's just a different investment account type. So in the same way that we talk about, well, I mean, there's more to it than that, but in the same way that we talk about a tax-free savings account as being a named account type, well, so you can also have a donor advised fund that you've got in there. Essentially, it's this investment account that sits over here. You, the donor, you donate some money to that investment account. So at that moment, once you've donated the funds, it's out of your hands to some degree. You send it over there. You
It's an
collect the.
irrevocable gift.
It's an
You,
irrevocable gift. You have
yeah,
donated it.
yeah.
So you get the tax credit, but you have donated the money around. It sits in that donor advised fund. It has not yet gone to any actual charity. So it's sitting in this investment account. They have to every year give a little bit out to charities, but essentially what happens is you can put it in this investment account. It can grow over time if you want, if the investments do well, and out of there, you as the donor, you can advise the fund where you want those proceeds to go to. So you want some amount to go to this charity and some amount to go to that charity, and they will take your instructions. It is again, donor advised fund. You as the donor advise them how to make those distributions.
So just a little clarification there. The donor advised fund is actually a charity or is part of a charity. So you are actually donating it to a charity. It just happens to be a charity that will um, allow you to advise them.
Yeah, well, it's
Legally,
like
you
it's
don't
a
have
charity
authority
that distributes money to other
that to other
charities,
charities.
right?
Yeah,
It's not
yeah,
the end charity
yeah,
or
that's
the
right.
end goal of the
Yeah,
money. Yeah.
yeah. And legally you've lost legal control of it. You don't own it anymore, but they will accept your advice in terms of distributing it. And so that makes it black and white legit. We deal with a few organizations that do that. There's a number around that do. The Strategic Charitable Giving Fund is one that we use. That's put out through Mackenzie. I'm on the board of directors of Abundance Canada. That's the old Mennonite Foundation. They also do the same thing. Um, some of them, most of the time, they're just like Ben described. You're sitting on that money and it's invested and growing, and you're distributing part of it. But sometimes it's just a straight flow through transaction. In the case that we were talking about before, where you have a end charity that doesn't have a brokerage account. Well, there are organizations like Abundance, or there are other ones as well that for a small fee, you can donate to them and they'll just be a one-time flow-through entity, and then they'll donate it directly to the end charity that you want, just because they don't have a brokerage account, they can make it happen. Um, I kind of view them as a poor man's foundation, right? If you've got $10 million that you're donating to somebody and you want to distribute it over time, you can set up your own foundation.
Yeah, poor man's is a bit relative here, I
You know,
think.
well, but if you have less than that, but most of these, I think they want a minimum of $25,000. So for 25 grand, you can have your own foundation. It's not, but you're using a foundation, right? So the foundation has an account in your name, and you're distributing it. There are, I believe, some online ones that will actually do it for even smaller amounts. But in most cases, if you're thinking about long term, usually you're thinking a slightly larger amount of donating. And again, if you're donating securities that have gone up in value, or if there's another um, emotional reason, and I think Ben's got a good example of this one. Um, Oftentimes, that's just a really cool, great way to create a long-lasting legacy. And I know some people who combine annual gifts in kind to their donor advised fund, and then through their donor advised fund, um, once, twice, three, four times a year, donate out of that. And especially the last few years, they've also gone up quite a bit in value. So it's a very good feel good.
Yeah, well, and to touch on that too, like on a couple of things there is that number one, it's not an either or thing. It's not as though you have to decide the donor advised fund or
Right.
giving, securities in kind that have appreciated in value. You can do that into the donor advised fund.
That's
You
right.
can list the donor advised fund as the beneficiary on your RSP and so on and so forth. So they can work in tandem with the other ones and be flexible that way. And then number two is in terms of wanting to leave an ongoing legacy, like in a sense, that's what we've done. You and Mom have set up the Machel Family Charitable Fund,
That's right.
and at this stage, it's mostly you guys giving money into that. But I love the idea that down the road, at some point, if you're unable or unwilling or for whatever reason don't want to manage that anymore, or after you guys have passed away, some of me and my siblings can then take the reins and say, oh, you know what, now we're going to manage this bucket of money there that the prior generation has given to, we can start giving to it as well.
That's
Or if
right.
we choose not to, we can help distribute the funds.
Yeah.
So yeah, I love it for that. I love that idea, and yeah, it's a really good way of doing it. To your point, it's like a foundation, but not so costly to set up. You don't need
That's
so
right.
many millions of dollars to get it in place. So,
Yeah,
um,
and I think we've talked about some of the key benefits, but just to highlight a few more of them, it really does help divorce the decision of um, uh, when you want to give a sum now, but you don't know where or when, you don't know where you want to give ultimately the money to down the road, or you don't want to give it to a charity right away. And so you can donate it all to your donor advised fund. I'm going to call them a DAF. That's how we call it because it's quicker. You donate to your DAF, and then basically for the next 3 years, you distribute it out of there. And a good example, actually, I've had a couple clients where this has happened. They had very large capital gains on securities that they wanted to get rid of. Um, and so they normally were charitable. Um, and so I said, well, you know what? Why don't you give 3 years worth or even 5 years worth of your donations out of that stock? You want to sell it, but instead of doing that, you're going to be giving this money anyhow. Donate that amount of the securities to wipe out that capital gain. And then they just continued to give the exact amount that they would normally give, but now instead of out of their own cash, out of their donor advised fund. And so their church or their favorite charity didn't get the money all at once. It got metered out just like it normally would. Or in another case, they divided it up among a whole bunch of different places. So it's great because it creates a flexibility of the timing of when you donate to that master charity. One of the other pluses is if you utilize one very heavily and don't donate directly to a bunch of places, you end up with just one receipt from that organization. Because the ultimate charities, they're getting the money from your donor advised fund, so they're not issuing a receipt. So you only have one receipt to deal with.
One receipt, and you can, if you choose, remain anonymous to those other
Yes,
charities that
good
you're giving
point.
to,
Yeah, that's right.
or you can let them know who it was.
Yeah,
That's in your control there. And so, yeah, it's just kind of nice to be able to do that, to your point, meter out those distributions over time, or it's in your choice to give more if you want. But like a lot of charities too, on the one hand, they'd like a lot of money up front. On the other hand, they might not have capacity for it. They also like stable cash flow
yeah,
like anybody else. And so to be able to distribute that and for them to know that they're going to get the same amount every year or something similar,
right.
can be pretty nice there. So, yeah, so we had actually an example of this one that we set up for a client, and this was a case where a family unfortunately experienced the loss of their daughter prematurely. And they thought, okay, well, it would be nice to, we were eventually going to give her, they had 3 kids, they were going to give her a third of the estate at the end of the day. And so they made the decision that, you know what, we're still going to treat her third of the estate as hers, but just donated it to a charity in her name. So they did set up a donor advised fund in this daughter's name. They selected a few charities that they knew she liked. And the idea was, okay, well, let's fund it a little bit up front, and then let's also, you can continue giving her birthday money into it year over year. Other people can donate as well if they want into it. But ultimately, the big piece was just that it's going to be treated as the beneficiary of the estate, and approximately a third of what will end up being the estate will go into that donor advised fund and preserve the daughter's legacy while still maintaining the family's flexibility in terms of how to do that. So yeah, I thought that was a really good way of handling it for them. So it's not just about efficiency, it's about the meaning for the family and how they want their financial impact to impact other people's lives.
Well, Ben, you brought up a really good point there. So they have a couple of named charities that just automatically the donor advised fund is sending that money out to those charities. It's an automatic thing, but it's not a forever thing necessarily. The family can choose to change that at any point in time. So you sort of have the best of both worlds there is easier administration, but flexibility.
Yeah. Yeah. Yeah, so I'd say just generally speaking, again, we touched on it at the beginning, but try not to leave too much of this too late. If you are giving or planning to give soon, start to give some thought as to the best way to do that. Coordinate some of your different estate pieces that are going into it, the will, the anything like that, your life insurance, other things like that. And definitely when you're doing that too, I think it's important to document the intent pretty clearly for your executors, let them know how you want the money to flow, and that kind of stuff. Just sort of
Well,
ask yourself, yeah,
I,
do you want to give during
I,
life? Do you want to give at death, or both? How you want to handle that?
on that point about the executors, Ben, I am a huge fan, and you know this, but I'm a huge fan of family meetings. Um, Telling your heirs, telling your family what you're thinking, what it's good to document it, but it's almost as important to chat about it in advance
Mm,
because then people know, and it's not just black marks on white paper. They get a sense of how you're feeling about things, because later on when you're gone, sometimes things are a little bit fuzzy, even though it's black marks on white paper. There may be some decisions that have to be made, and if they have a sense of what you're thinking because you've had a chat with them, everybody's likely to be more amenable and understand better what you're thinking and just do it better. Whether it's inefficient or inequitable distributions of estates or giving to charity or anything like that, talk to your heirs about what's going on in your head. It is so worth it.
yeah, yeah, definitely. So yeah, I mean, charitable giving, it's one of those areas where financial planning stops being abstract. It becomes very real, because it's not just about tax credits or efficiency. It's about what you care about, who you want to support, and how you want to be remembered. What we see over and over again is that the best charitable plans, they don't happen by accident. They're intentional, coordinated, and built into the broader retirement and estate plan. And when that happens, giving becomes easier, more impactful, and often more meaningful for everyone involved. If charitable giving is something you're already doing, or if something you think you might want to do, it's worth having a proper conversation about how it fits into your overall plan. So thanks for listening to the Retire in BC podcast. If you found this episode helpful, please consider subscribing or leaving a review. And as always, if you have questions about retirement, estate planning, or charitable strategies, please feel free to reach out. Thanks. Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.